Okay, let's get started today. Now, last we talked about budgets, now a different kind of budget called a flexible budget. And we look at standard costs. Okay, now, what is a flexible budget? Now, remember, the ones we did before, regular budgets, those are considered, a master budget, and it's called a fixed budget. It means it doesn't change. All right, a static budget. It means based on a single, activity measure, sales amount, and it doesn't change. It doesn't matter how much we do, it doesn't change. A fixed budget is the exact opposite. This one, it fluctuates each period because it's based on your actual level of activities. What did we actually do? Now again, a fixed budget is based on a single predetermined amount. It means before the year started, this case for example, we thought we were going to do 10,000 units we're going to sell. We ended up doing 12,000. Now remember, all of our figures were based on the 10,000 units, but we actually did 12,000, so we're a little bit different now. It says, well, wait a minute, what happened here? Now again, next to each figure, you get a mark here. Did you get a U or an F? An F means it's good. Okay, they're considered a favorable. It means you did pretty well here. A U means you did not do well. It means unfavorable. It means you did not do well. So it's kind of the opposite in school. You actually want all Fs here. If I told you you got all Fs, I'd be like saying great job. Okay. Now why do we have flexible budgets? Because that's the problem. They're not going to match up a lot, especially if you did more or less. You want to it shows revenues and expenses at their actual level of activity. It says, okay, here's what they should have been. Because based on, obviously, here's what it should have been. And maybe appear for several activity levels, such as, okay, here's where we'd be at 10,000 units, 12,000, 4,000. And any variance means differences due to good cost control or lack cost control. And the whole point is you want to hold all your managers accountable. It says, well, how can we make you better? Improve your evaluation. Focus on any problem areas. Say, well, we see you're not doing well here. How can we fix it? Again, to flex it, it means your variables change every period. Such as May, June, July, okay, variable costs change because based on how much your actual activity was, not your estimated. At fixed cost, it doesn't matter if you do 1 unit or 1,000 units, even with flex, it stays the exact same, such as your rent. And here's where the benefit says, all right, based on what our sales is, all right, here's where we should be. Variable cost should be at 10,000 units, 12,000. If you notice, fixed cost doesn't change, stays exact the same. And like it says here, compare it. It's all right, a budget for 12,000 and actual. You sold more, you got a higher sales cost, you made more in sales than you should have, so you get an F here. That's good, it's favorable. Variable cost, you spend more. Yeah, you say, well, we spent more, but in the meantime, we sold more. Overall, I'd still say you did well for one reason. You're moving from operations, you still got an F there. You're favorable, so you're doing well. Okay, that's what I need to know here. It says, okay, compare a fixed budget to actual results. Again, assumptions here. Always take, obviously your sales revenue divided by how many units to get your cost per unit. Give your budget assumptions here. So we see here you didn't do too well because you start off with sales, you got an F, that's good. But in the meantime, your variable costs, you got a U here. That's not good. It's a pretty big one. You weren't able to overcome it because overall, your net income, you got a U there. That's unfavorable. That's not good. Standard cost now. Standard cost says, all right, what should it be? So what's reasonable? I mean, it's not, or it's like, it's too high, it's too, or in the meantime, too low. So it's all right, what would be a reasonable price for anything? How much you pay your employees? How much you pay for goods, materials? What should you be? Expected level performance. How do we measure performance? So used for benchmarks. As well, why is it selling for $5 and you pay $20 for something? That's not right. Identify a standard cost. Remember, here's something everyone should work together here. From accounting to HR to engineers. The whole point is it should be challenging yet attainable. And take into account everything. Say, well, we're all human. Things break down. Every now and then we might make a mistake. We might have some downtime. Again, set your standards. Everything from price to quantity. Direct labor. How much time? What should your rate be? Even the overhead. It says here, standard cost. Here's how much, obviously for each unit of wood, we use 1 kilogram. You spend about 2 hours and your overhead. So each time a standard cost to make that object, that product will be $85. What do variances say? Again, if the actual cost is higher than standard cost, you get a U. If you spend less than you should have, you get an F there. It's good. It's a favorable. And again, the whole point is when we look at these variance analysis, review them. Why was there a variance? Why did we spend more or less? And here's probably the most important thing, especially if you get a lot of U's, take action. Start doing things. The whole point is any problems that cause unfavorable variances, correct them. Reward the practice that result in an unfavorable variance. Or, if you got an F. Again, you always do the cost variance. Compare the actual cost minus standard cost. Or actual quantity minus standard quantity. Actual price, standard price. Pretty much what you actually did, what you should have done. Or what you spent, what you should have spent. Look at your cost variances here. How much quantity did you actually use that product? How much wood, how much metal did you use? Between how much you should have used. Again, look at the variances here. You said standard quantity is a quantity that should have been used for the actual good. Standard price amount you should have been paid. Again, we're doing comparing here. It says here, makes golf club heads here. What's the dirt materials? Okay, standard cost for each golf club head should be about $26. How much materials we use, how much, at what price, and direct labor. 1 hour per unit at $16 an hour. And materials cost variance. You see $26. So we see here, standard costs here. And how much pounds? 3,500 units at a half a pound. So we see it's unfavorable because you actually spent more than you should have. But the quantity was favorable. That was also unfavorable. So overall, not too good. Dirt materials, I'd be a little concerned here. You get a U here. U's are not good. How do we evaluate it? All the time you say, well, who's responsible? The manager says, well, I'm not responsible because you bought cheap material. The director, let's say the owner, says, nope. Because poorly trained workers, poorly made equipment. Again, we look at who should be held accountable. Again, like I said, you need to know here, compare things. Use a chart here. Look at labor cost variances here. Terms, rates, and hours. What's your rate of variance, your efficiency variance? How efficient are you being? Again, labor rate, efficiency variance. Now, how many actual hours did you do? You should have been, what was your actual rate, your standard rate? How much time should you have spent, man? How much time you actually spent making those golf club heads? The first one, you get an unfavorable variance, your rate. The efficiency variance, you're a little bit better, but overall, you still got a U there. You want to be out to U's. You want an overall F. Labor cost variance. Look at labor rates and efficiency. Probably, you might use highly skilled workers. Rate variance, unfavorable rate variance. Fewer labor hours, but in the meantime, you have to pay more. That's the problem, high skill, high rate, or low skill, low rate. So you got to find what best fits your company. Even labor cost variances. Well, the manager says, well, I'm not responsible. You put cheap material too long to process. Corporate says use too much time because of poorly trained workers and now poor supervision. Again, need to know here, again, just like we've been doing. Do an overall chart here. So overall, we'd be concerned here. You get a huge unfavorable variance there. The last part, overhead standards and variances. So again, start with the predetermined overhead rate. Where should your overhead be? At standard activity. How do we allocate overhead costs? Compute the standard overhead rate. Further, determine your allocation base. Is it machine hours, labor hours? What should it be? Predict activity level. And compute standard overhead rate. And we see right here, so all right, flexible budget, different percentages of monthly capacity. Is it 70, 80, 90, even 100%? And obviously, the more you produce, the lower the rate's going to be. You said, well, it should be about 80%. Again here, is defined as, look at different things here, your overhead cost variances. Yeah, it goes controllable and volume variance. With our volumes now we're getting into. We see here, controllable variance, overall unfavorable, and even the volume variance. How much volume is what we're producing. Again here, with everything we've been doing, it all goes back to this right here. It's okay. Here's how much would be overall. What should our overall variance be? And again, any changes in expected amounts? Any sales variances? Okay, let's look at certain things here. What was our budget compared to our actual? Again, compare everything. Look here again. All we're doing now again, comparing actual results to flexible budget, to fixed budget. Okay. Any thanks here and variances in here. A little bit different here. Look at overall everything. All right, class. That's all we got for today. Let me know if anyone has any questions. Okay. All right, take care.